nature enters the balance sheet. For a long time, nature, carbon, and climate lived on the edges of investment strategy. They mattered, but mostly as compliance boxes or reputation management. That line is disappearing. Markets are increasingly treating ecosystems and climate resilience as factors that directly affect returns, asset values, and long-term stability. Private finance flows reflect the shift. Capital directed toward nature-related investments has risen sharply over the past few years, growing from under $10 billion to more than $100 billion. Forecasts suggest that, if current momentum continues, this could reach 1.45 trillioners by 2030. Even so, the gap remains wide. Biodiversity alone is expected to require close to 1 trillion annually by the end of the decade, while total global flows currently sit around 200 billion, with private capital accounting for only a small share. The imbalance is forcing investors to rethink how risk is assessed. Carbon markets, climate adaptation, and nature-based solutions are no longer viewed as separate themes. Instead, they are converging into a broader set of asset classes tied to resilience, infrastructure performance, and long-term economic viability. Nature as Economic Infrastructure Africa illustrates this convergence clearly. Natural capital accounts for an unusually large share of national wealth across the continent, often between 30 and 50%. In South Africa, functioning ecosystems contribute an estimated $14 billion annually, around 7% of GDP. When those systems degrade, the impacts are economic as much as environmental. Flood damage in Kruger National Park and ongoing water stress in the Western Cape have translated into real costs, from infrastructure repairs to disrupted business activity and fiscal pressure. These are near-term financial exposures, not future climate scenarios. For investors and lenders, this reframes nature as a form of economic infrastructure, where ecosystems underpin water supply, agriculture, and transport resilience. Their decline can erode returns quickly. Protecting and restoring them becomes a way to manage downside risk rather than a trade-off against profitability. Turning climate and nature into bankable assets. This thinking underpins the approach of Africa's Green Economy Summit, AGES, as it shapes its 2026 agenda. The program opens with a climate, carbon, and nature financing academy designed to move from high-level ambition to structures that can sit on institutional balance sheets. The focus is on execution. Carbon markets, green, blue, and wildlife bonds, debt-for-nature swaps, and performance-linked financing models that connect environmental outcomes with financial metrics. The premise is practical rather than aspirational. A climate-resilient Africa is closely tied to global supply chains, commodity markets, and economic stability. Investment in adaptation and mitigation is therefore about protecting growth and managing systemic risk, not philanthropy. The challenge now is scale. These emerging asset classes depend on credible project pipelines, consistent measurement, and policy frameworks that reduce uncertainty. If those elements align, nature is likely to move from the margins of finance to a core input in how markets price value, risk, and resilience over the next decade.